Most investors are stuck in a portfolio tug-of-war. Do you go with the explosive, tech-heavy growth of the NASDAQ 100 through QQQ, or do you play it safe with the tried-and-true stability of an S&P 500 fund like SPY? It's a classic dilemma. Chase high risk and high reward, or settle for safer, but often average, returns. Either way, it feels like a compromise. But what if you didn't have to choose? What if there were a way to capture the power of American growth stocks without concentrating your risk in just a handful of tech giants? Today, I want to show you one ETF, the Vanguard Growth ETF. Ticker of the ETF is VUG. If I had to choose only one ETF, this ETF would be the perfect choice. I think it's highly underrated and barely talked about on social media. In this video, I'll explain why from 4 key perspectives. First, holdings and diversification. Second, long-term performance. Third, cost efficiency. And finally, liquidity and scale. By the end, you'll understand why VUG stands out as a core long-term investment. Without further ado, let's begin. Before we go any further, let's quickly define what VUG actually is. VUG is the Vanguard Growth ETF. It's a passive ETF designed to track the performance of U.S. large-cap growth companies. Specifically, VUG follows the CRSP U.S. Large Cap Growth Index, which selects companies based on objective growth characteristics, such as revenue growth, earnings growth, and other forward-looking fundamentals. This is important. VUG isn't actively managed, and it isn't making discretionary stock picks. It follows a rules-based index, which means its exposure is systematic, transparent, and consistent over time. In simple terms, VUG is designed to give investors broad exposure to large U.S. companies that are growing faster than the overall market without relying on market timing or active management decisions. With that context, let's move on to what really matters: composition of the fund. Let's start with what the fund actually holds, because this is where VUG clearly separates itself from both QQQ and VOO. QQQ holds around 100 stocks, all drawn from the NASDAQ exchange, and it excludes financial companies by design. That structure creates a very specific exposure profile. It works extremely well when large-cap technology is leading the market, but it also means your portfolio is tightly tied to a single exchange and a relatively narrow slice of the economy. SPY sits at the opposite extreme. It holds hundreds of companies across every major sector, effectively giving you the entire U.S. market. That level of diversification provides stability, but it also means growth exposure gets diluted. You don't just own the fastest growing companies, you also own slower moving businesses that can weigh on long-term returns. VUG is built differently. In terms of breadth, VUG typically holds around 160 stocks, well balanced between QQQ's roughly 100 holdings and SPY's more than 500. Instead of being limited by an exchange like QQQ or trying to own everything like VOO, VUG selects companies based on growth parameters. Its holdings are chosen using a rules-based methodology that focuses on large-cap companies with measurable growth characteristics. That approach allows VUG to include high-quality growth leaders beyond just technology. For example, VUG has held companies like Eli Lilly, which has delivered dramatic growth over recent years, driven by innovation in pharmaceuticals and obesity treatments. That kind of exposure matters because it shows this ETF isn't just about owning big tech. It's about systematically capturing growth wherever it appears across the economy. The result is a portfolio that holds more companies than highly concentrated growth ETFs, but far fewer than a total market fund. That middle ground is intentional. VUG maintains meaningful sector diversification while keeping the portfolio aligned with growth. Technology remains an important component, but it's balanced with exposure to other growth-oriented sectors, such as healthcare and consumer-driven innovation, rather than being dominated by a single theme. Because the selection process is systematic and rules-based, the portfolio remains consistent over time. There's no discretionary stock picking and no style drift in response to market noise. So when you invest in VUG, you're not choosing between concentration and over-diversification. You're choosing a structured growth portfolio that's diversified by design and anchored in clear, repeatable rules. And that construction is a big reason why VUG works so well as a long-term core holding. VUG doesn't try to predict winners. It systematically holds the companies that are already delivering growth. When it comes to investing, most people don't think in percentages. They think in one simple question: how much money do I end up with? So instead of focusing on charts or ratios, let's look at ending portfolio values across 3 realistic scenarios, comparing VUG and SPY, using the same dollars each time. Scenario 1, investing gradually. Since 2009. First, imagine you started investing in March 2009, right after the global financial crisis. You invest consistently over time, the same amount on the same schedule. By the end of the period, the difference is clear. With VUG, the portfolio grows to $207,000. With SPY, it grows to $163,000. Same contributions, same timeline. VUG ends up with more than $44,000 extra. That's not timing, that's compounding. Scenario 2, lump sum invested in 2009. Now let's simplify it. Instead of investing gradually, you invest $10,000 all at once in March 2009, and then you do nothing. By late 2025, that $10,000 becomes $180,000 in VUG, $136,000 in SPY. That's another $44,000 difference from the exact same starting amount. Same market, same time period, different outcome. Scenario 3, the last 10 years. Now let's make this harder. Forget the post-crisis rebound. Let's look at the most recent decade, from 2015 to 2025. You invest $10,000 once, and again, you just let it run. At the end of the 10 years, VUG grows to $49,000. SPY grows to $39,000. Even in a tougher, more uneven market, VUG still finishes with over $10,000 more. What all three scenarios have in common. Here's the important part. Across gradual investing, lump sum investing, long time frames, and more recent market conditions, VUG consistently ends with more money. Not because it avoids downturns, not because it times the market, but because a growth-focused portfolio, given enough time, compounds faster. And in the end, that's what matters. Performance isn't a percentage. It's the dollar amount you end up with. And across every scenario we just looked at, VUG ends higher. Fees are one of the few variables investors can actually control, and over long investment horizons, they play a much bigger role than most people realize. VUG's expense ratio is 0.04%. That means you're paying just $4 per year for every $10,000 invested, extremely low for a growth-oriented ETF. There are ETFs that are marginally cheaper. Broad market funds like VOO, VTI, IVV, and SCHB charge around 0.03%, and some S&P 500 trackers like SPLG go as low as 0.02%. But here's the important distinction. Those cheaper ETFs provide market average exposure. They're designed to track the broad market as efficiently as possible, not to tilt toward growth. On the other end of the spectrum, QQQ charges 0.20%, which is 5 times more expensive than VUG. That higher fee comes from its structure and branding, not from any active management advantage. VUG sits right in the middle, and that's what makes it compelling. At 0.04%, it's only 1 or 2 basis points more expensive than the very cheapest market cap ETFs, but historically, it has delivered stronger long-term performance thanks to its growth focus. This is the key takeaway. The cheapest ETF isn't always the best ETF. What matters is the combination of cost and return. VUG isn't the absolute cheapest option available, but it's cheap enough. And historically, it has justified that cost with better growth outcomes than many lower fee alternatives. That balance is exactly what you want in a long-term wealth-building ETF. The final piece of the puzzle is scale, and this is where VUG quietly stands out. VUG is one of the largest ETFs in the world, consistently ranking around the top tier, roughly the 6th largest ETF by assets under management. That level of scale matters more than most investors realize. A fund this large isn't niche. It isn't experimental. It's deeply embedded in institutional portfolios, retirement accounts, and long-term investment strategies. High assets under management also translate directly into liquidity. VUG trades with very high average daily volume, meaning buyers and sellers are constantly present in the market. That keeps bid-ask spreads tight and makes it easy to enter or exit positions without price distortion, even during volatile market conditions. For long-term investors, this reduces friction. You're not worrying about whether you can execute trades efficiently. You're not exposed to liquidity risk. And you're not relying on a fund that could quietly disappear. This scale also reinforces trust. Large liquid ETFs tend to persist. They're easier to manage, cheaper to run, and far less likely to be closed or restructured. That stability is exactly what you want when you're building wealth over decades. So when you combine disciplined portfolio construction, strong long-term performance, low fees, and massive scale with deep liquidity, you get an ETF that's not just effective, but reliable. And for long-term investors, reliability is an underrated advantage. So let's bring everything together. Most investors feel stuck choosing between extremes, highly concentrated growth on one side and broad market average exposure on the other. VUG stands out because it doesn't force that trade-off. Its portfolio construction is intentional, diversified across sectors, built using clear, rules-based growth criteria, and focused on companies with stronger growth characteristics. Historically, that structure has translated into stronger long-term performance than the broad market without taking on the concentration risk of narrower growth funds. At the same time, VUG keeps costs extremely low. While it isn't the absolute cheapest ETF available, its 0.04% expense ratio is close to the market floor, and it has historically justified that cost with better growth outcomes than many lower-fee alternatives. Finally, its massive scale and deep liquidity add another layer of confidence. As one of the largest and most actively traded ETFs in the market, VUG offers stability, efficiency, and reliability. Qualities that matter when you're investing for decades, not months. That's why I think VUG is highly underrated. It's not the most talked about ETF. It's not the flashiest, but for long-term investors who want growth, discipline, and simplicity in a single holding, VUG makes a very strong case. If I had to choose only one ETF, VUG would be it. This content is for educational and informational purposes only and does not constitute financial, investment, or legal advice. The information presented reflects personal opinions and is based on publicly available data at the time of recording. Investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Always do your own research and consider your financial situation, objectives, and risk tolerance before making any investment decisions or consult a licensed financial professional.